All right. Happy Friday. Good to see some new faces and some old faces too. Shout out to Sam. Thanks for being with us today. Yeah, I'm going to jump right into it here. You got questions, put them into the chat. You got any comments or Q&A, put them in there. Yeah, let me get started. Today, before we jump into the earnings watch, I want to I want to go through a few news items because I want to take a minute here to provide some very specific examples of the difference between news and noise. First of all, disclosures and disclaimers. We are not giving out any advice. We are not tax advisors. We're not investment advisors. We are information providers. We are publishers of information for making your own more informed decisions. But let's take a minute to talk about news versus noise because we've entered a cycle in the saga or era where we're seeing a disconnect or conflict. A lot of the people who were positive on AI aren't so positive anymore. You still got the super positive people that are believing in amazing, potentially even magical things about AI. And you've got some people saying, wait a second here, this is looking a little bit bad. So this is an interesting stage of the cycle, so to speak. We've got a lot of big headlines coming out, and I want to talk about a few of them because I think some of these are news and some of them are absolute noise. And then some of them are proof that the noise is noise. So let's talk about this one, for example. SpaceX confirmed plans to build a $100 billion launch site in Louisiana for its Starship rocket. I think that's news. I think that's probably a big deal. I think they're going to build another launch site. They've got a successful one. And that part of this SpaceX business, I believe, is a very strong piece of the business. The SpaceX part, the actual launching of rockets, I think that stuff is good. And the launching of satellites and Starlink, I think that's a real business. That part of it works. I think another interesting headline here about how Europe is developing its own Palantir. We don't hear about them developing other kinds of companies to compete with specific American companies, but we do hear about Palantir. Why? Because I think that's a good business model. Now, I'm not saying it's a cheap stock. It is not. And it's not something we would think is a good investment at this point because I think the smart money knows Palantir's got a good business model and it's been up the price a lot. But in particular, the Palantir business model is very different, almost counter to what from Anthropic and OpenAI and all the closed models. And that is that Palantir saying you need to build your own sovereign AI to enterprises, to corporate America. You should build your own sovereign AI because your data is your asset. Don't put your AI into Anthropic or OpenAI. Don't put your data into Anthropic and OpenAI because they're just going to use it to create what you have already to compete with you. Palantir says, don't do that. We'll help you build a customized AI solution for your data set because your data is your asset. And so I think the fact that this is a headline is important. Validation, that is the right business model. Now, news do some noise. Dick's Sporting Goods was just a super overpriced stock. And any kind of back news, you're going to see the stock get crushed. And this has been a popular one, unrelated AI, popular stock. And you can see when some bad news comes, you get hurt pretty bad. So warning about what happens to really overpriced stocks. Another interesting situation here that is a couple of a double set of points here for this one. Number one is there's more than one robot company or one robotic company. There are a lot of robotic companies like Boston Dynamics that have been around for decades that have some really successful robots. And it doesn't, you may have already seen some of these in your feed, Twitter or Instagram. I don't even know where they are, but they've got robot Olympics now where they're like running races. They got robot boxing and fighting, I think robot MMA. And so there's some pretty sophisticated robots out there. So keep that in mind for any companies that are claiming they're going to revolutionize the robot industry or business. But this is a good example of a robot company that ran a big run up, but saw a huge drawdown here recently, $30 billion drawdown here because it's just an overpriced stock. And again, I want to say overpriced in the context of being priced as if you're going to be the winner, right? We see a lot of AI stocks priced as if they're going to be winners, big time, like monopolistic winners. And I just don't think that to be the case. Here's some just good information too about AGI, right? I mean, they've been claiming AGI for a long time. And we're seeing no evidence of it, I think is the takeaway here. Big tech is saying build it and they will come at an unprecedented cost. I think we're still seeing claims that AI is around the corner because that's what's necessary to get the Anthropic and OpenAI IPOs done. And make no mistake, those are $100 million paydays at minimum for Wall Street. So there's a lot of incentive to get those done. Speaking of IPOs, Anthropic is likely to tell investors its potential revenue opportunities are above 30 trillion, bigger than even SpaceX, so that they can do a $2 trillion, even bigger than SpaceX IPO, raise $100 billion. That's not something I think is a smart move. I think they're talking about, anyway, $30 trillion addressable market. SpaceX's addressable market was pretty ridiculous. And look, as I've been saying for a while, these AI models just aren't that good without data. DeepSeek, by the way, has models that do just about as well as Anthropic, maybe better in some cases. And it's going to raise 7.4 billion, 100 billion, 7.4 billion. What's the difference? What's the difference? Good for DeepSeek, $74 billion valuation compared to $2 trillion valuation. What's the difference? Interesting, right? And then I think here recently, we're actually seeing the FDIC Corporation, the Federal Deposit Insurance Corporation, a new set of rules refocusing supervision on what matters most, material financial risk. A wider deregulatory push under the Trump administration has also led regulators to scrap reputational risk. Folks, I think people are getting nervous, getting a little nervous. There's a lot of banking going on that's not in the banks that maybe we need to pay attention to. So for that, let's go ahead and any questions on any of that, let me know, but we will go ahead and jump into our earnings watch from here. So let's start with Dick's Sporting Goods because we already talked about that. Before the drop here, this was expensive. It was one of the more expensive stocks. We've since seen a huge decline in valuation. Still not looking that good. Still not that good at business. As we know, their earnings report was not so positive. Was a very expensive stock. Became starting to get cheap. Not cheap yet. Free cash flow is still pretty big negative here. You can also see economic earnings headed down when accounting earnings are looking positive. That's not good. A number of shares coming down. That's a good thing. Return on invested capital in the decline. Margins declining. Capital turns declining. So balance sheet and income statement performance looking down. And look, you got a big negative 7 billion here. That's not good. Probably related to an acquisition. And then we see here price to economic book value. Still at its current rate, it's still 1.46. So not cheap. Better, but where was it just not too long ago here? Looking at a 2.24 price to economic book value on a retailer, puts it here at neutral. Look for a business that obviously doesn't have a ton of growth opportunity. That's pretty expensive. And I think just in general, you want to be careful of any business that has a lot of growth expectations, but one like this that's going to be tough to justify what we're looking at here for a retail operation. All right. Next, let's look at NVIDIA. Sort these by market cap. By now, I think we all know the news on NVIDIA. Strong report. Down today, but up pretty solid overall for the week. Did good for the market in general, I think, NVIDIA's report. We're seeing the same thing that we've been seeing with NVIDIA for a while, which is a really expensive stock. In fact, when we are looking at we call sort of the big AI stocks, it's interesting when we compare these folks. We're looking at off balance sheet debt and what's going on, and looking NVIDIA, they're so profitable that they are willing to take the sort of entire AI movement on their back here and continue to give other firms money to make sure they can keep spending, keep buying their chips. But the last exhibit, see huge increases in not yet commenced leases, right? This doesn't even capture the purchase commitments, which are even worse. So these debt numbers are really, I would almost say out of control compared to what the companies have done in the past. But the big thing is the valuations. What do the future profits have to be? And when I say they can't all be winners, that's what I'm talking about. These are already really profitable companies. And their prices are projecting huge multiple increases as if they will win the lion's share of everything related to do AI. I just don't think that makes any sense. If AI is such a great technology, it's such a revolutionary technology, I think it makes sense to compare and think about it like to something like electricity. Who makes money on electricity these days? It's a utility. AI, I think, is going to be one of those things that's going to have a lot of utility-like comparisons where where most of the value is going to accrue to individuals. I just talked to a friend of mine in the construction business today. Guess what he's doing? Using AI to reverse engineer all the software services. He's AI. He's not going to build an AI based on OpenAI or Claude. No, he's going to build a private sovereign AI. It's a great story that came out this week from my guy, Matt Robinson, who does a ton of AI work. And guess what his focus was? Hedge funds are hiring AI people to teach their own sovereign AI how to use their private data. Folks, data is the asset, like I said before. So all this AI is going to be really focused on individual users making the most of their own private data. Otherwise, there's no value add. Yeah, exactly, Sam. Data and trust, right? Anyway, you shouldn't trust Anthropic with your data or OpenAI. What have they been doing over the last couple of years? Looking at all their user interface, user activity, user logs, and then introducing new skills and features based on what they've seen, how they've seen people use it. Yeah, they hire some people to do that too, but a lot of it's based on what the users did. So you get good data, you got to keep that private. That's your asset. That's what every firm's core asset is. It's data, it's proprietary data and processes. That's what makes the difference. So to expect all these firms' profits to skyrocket means that they win the value from AI. And I don't think that's what AI is about. I don't think they can win if they win all the value. Because basically that means consumers are going to be paying through the nose for AI. And we already know there's no reason to pay Anthropic or Claude or OpenAI prices when you can get the DeepSeek price, when you can get the Moonshot Kimi price, and other open source AIs that are coming out all the time. And that's what people are using. I don't know if you guys saw I think maybe we talked about this last week, the interview with the CEO of Hims and Hers, talking about how he believed that the foundational models, independent of a closed loop data system, which is a proprietary data system, have no value. He said, don't add a lot of value, something like that. He didn't say have no value. But again, it's about the data. A good company, expensive stock, folks, really expensive. And I think that's maybe why you're seeing some profit taking today. Because people are like, yeah, I love NVIDIA. I don't know if I love it forever. The market's down flat today. And yeah, it just can't be. These numbers. It's a big profit number, folks. These are already crazy, super profitable businesses. High returns on capital, super high margins. Like these are all crazy. Now, Amazon's balance sheet's been a disaster for a long time. All right, what do we got next? Royal Bank of Canada. This is one we've liked for a long time. Good company, cheap stock. How'd they do this week? All right, flat for the week. Probably around like the S&P 500. I think they had good performance. Beat, a little bit of loan impairment, valuation premium. Yeah, I don't see this as much of a premium. I do see the geopolitical tariff stuff as potentially a headwind, but this is one of the better stocks out there, folks. There's not many good companies, good stocks that are left in the market. That's why this is on our focus list. This, by the way, folks, is our professional membership, what I'm showing you here, these capabilities, what I've demonstrated so far, getting into the details. Yeah, you get improving economic earnings, improving returns on capital, good margins, good capital turns, free cash flow, strong. This is a great alternative to a lot of super expensive and crowded trades in the rest of the market. Marvell Technology. Not so good company, not so good stock. What kind of week did they have? Not so good. Strong earnings. Deferred Google partnership revenue is bearish. Sequential gross margin is bearish. And elevated valuation profile. So yeah, they've had a big run up here. Big run up. Look, this is typical to what we're seeing with a lot of technology stocks. And that's a good business. Super big run up in valuation. And look, guys, 26.4 price to economic book value. That's nuts. Right? It's coming from a small base, but you can see even NVIDIA, whose valuation I'm telling you is huge, right? 26.4 is one of the higher price to economic book value ratios we'll see anywhere. So this company this is another credit trade. Another example of a credit trade for sure. TD, another Canadian bank. Good company, good stock. Yeah. A lot to like in Canada, banks included, tend to be conservative folks. Let's take a look here. How'd they do this week? Up 3.78. Good banking. Had some anti-money laundering issues. I think there was a lot of foreign money buying houses in Canada for a while that caught them off guard. So that maybe hurting them. Sam, I think the issue with these banks is they're just underappreciated. Not interesting, not sexy. I think it's just an opportunity. That's my sense. And I don't know how many of you guys saw our super alpha stock bundle this week that went out, but we're seeing sort of unprecedented cheap stocks where we just don't see businesses that look this good being this cheap. I think part of it's a byproduct of just the gold rush to the AI stocks. Everyone's clamoring over those and they're not paying attention to some really good stocks out there. I think some people like the analytical tools. I don't think many people are out there saying, "Hey, look, this is a good looking stock. Great credit rating, great stock rating, strong free cash flow." That's one of the things I think a lot of people miss with these banks is that free cash flow is just strong, just crushing. But nobody on Wall Street wants to talk about free cash flow because if they talk about it for one company, that's what about these other companies? What's their free cash flow look like? And that's not good. I think this is just overlooked corner of the market. And that's what happens when you get into manias around AI. And I think we're in a bit of a mania about AI. CrowdStrike, just doing some deep work on this guy related to another project. But yeah, expensive, not good company, expensive stock, 84.1 price to economic book value. I think they got some backing recently from NVIDIA as well. So they're basically almost part of the AI mob here. Down, up for the week. Why did it surge? Oh, they had great revenue stuff. Look, AI, don't get me wrong, these could be great businesses. The cybersecurity is a big thing these days, for real. That's a thing. And AI tools are making it easier for people to build any kind of application, including cyber attacks. So you really got to be on your game, cybersecurity wise. These guys delivered strong numbers, strong forward guidance, and look, they're popular. So I'd probably want to do reverse DCF on these guys and just see how expensive they are because right now they're coming from a pretty low base. But the truth is, I think part of the problem here is that they've got effectively no profits at this point. So if they could swing to positive, yeah, you're looking at a negative NOPAT margin. So it's a huge swing. And if they could make the swing, we might be able to see some pretty decent performance. Let's take a quick run at this. So consensus has got them at 20% out there revenue. We've got optimistic 50% revenue compounded annually going out for 10, 15 years. Margins, let's just say margins. Let's see what we got on the optimistic side. Okay. So to justify the price, you're going to have to see 34% compounded annual growth in revenue with a pretty dramatic improvement in margins from negative 18 to positive 894 on average over 18 years. Let's take a look at what that would imply. Just do both of these on optimistic. Take a look at what that would imply on past versus future revenue. So you got revenue doesn't really even make the chart here, and you're getting up to 919 billion, almost $1 trillion in revenue. It's a pretty big improvement. We got NOPAT, we know that's negative, and that gets up to 81 billion. Free cash flow basically been negative, and that's going to get up to, it's also 81 billion. So you're talking some pretty significant profits growth for CrowdStrike priced in. Let's say that's an expensive stock. Might want to be careful. CRM, good company, expensive stock. They had a great quarter, reported some, I think, really good results, and people loved it. Look, this is a company that they lost a lot of money for a long time, but they really got established in a lot of places. So if they are really good at partnering with their clients to get them to put lots of data into their system, which they already have, this business could do pretty well. This is one I like, valuations that aren't crazy expensive like some of these other ones we've been looking at. And so this is one that's really pretty well positioned, and just that they are pretty deeply integrated into a lot of their clients. I don't know that AI is going to, at the enterprise level, maybe the smaller companies, they can use AI to build a tool that competes. But I don't think the bigger company it's going to be worth it for them. And to the extent that Salesforce does a good job of keeping people putting their data in their system, it's going to be very difficult to port that into something else. So these are pretty deeply entrenched, and I think can continue to do well despite a lot of companies truly dying and losing out in the SaaS apocalypse. I think it's real for some companies, not as much for Salesforce. So I think this week was a good week for CRM. Yeah, 25%. BMO, let's end it on another Canadian bank. This one not so good. So they're not all great. This one seems to be pretty expensive. So this one people are paying more attention to. And honestly, I don't have a good answer as to why. I wouldn't be able to tell you. I don't even know which one is the biggest. Let's see here. Let's click. So market cap. BMO, smaller than TD, smaller than Royal Bank of Canada. It's got a bigger investment bank, I think. I think they are much more involved. I see them around in investment banking and traditional Wall Street areas, and not as much a consumer bank. So these guys, how they do this week, not so great. Retail banking did better credit quality. How they do for the week? Yeah, not a great week. So yeah, this one's got a better valuation, maybe because the economics of this business really don't look quite as strong as the other firms. Got a lower return on capital, pretty strong economic earnings, free cash flow not nearly as strong, and then market implied growth appreciation period does not look good. That looks really expensive. That's a red flag. So don't like BMO as much as the other banks. And that's typically the case, folks. We're really pretty picky about the stocks we like and don't like. There's not a broad brush with the new constructs. We don't say, oh, this sector is great. There is no sort of perfect or great sector where everything looks great. All right, everybody, that's it. We're at our limit. If you got any questions, please email us. Have a great weekend.